Hi everyone, this is Stephen Elwell, Chief Investment Officer at Level Financial Advisors, and this is your first quarter 2019 market review. The first quarter was an excellent quarter by any measure. The U.S. stock market, international stocks, emerging markets, global real estate, bonds, basically every category of investments that we use in our portfolios did really well in the first quarter and a nice rebound from the fourth quarter of 2018, which many of you saw in the quarterly statements and in your Schwab monthly statements was certainly a rough quarter for the investment markets. There's a lot of good things that happened. The Federal Reserve clearly has decided they're staying put on interest rates and no longer raising rates this year. That the market doesn't anticipate that, and the Federal Reserve is kind of saying that they're not really going to be raising rates anymore for the rest of the year. There was concern both at the Federal Reserve and in the investment markets in general about the overall health of the economy and how the first couple of quarters of 2019 were going to play out. Fortunately, as the quarter went on, there was more and more economic data through either the jobs reports or the GDP reports or the manufacturing reports that confirmed that while yes, there is a bit of a slowdown, there's not necessarily a recession happening at the moment. That type of confirmation, that type of data, removed some of the worry from the investment markets and resulted in a nice rebound for the stock market and the bond markets. So that's definitely good. Also news that significant progress on a trade deal with China came out, several different pieces of information on that. So that all also helped the longer run economic concerns, that it kind of removed some of that worry. There was an end to the Mueller report, which also removed some uncertainty off the table. So that came to a bit of a conclusion. So from that perspective, the global stock markets kind of had a fair amount of worry taken off the table in the first quarter, which resulted in the markets bouncing back. And that really, it kind of goes back to the drum that we beat all the time about the dangers of market timing. We wrote about this in the quarterly letter, and we talk about it all the time. It feels right to kind of say, oh, well, I think this is going to happen, or I think that's going to happen, but the vast majority of the time, your intuition when it comes to investing is useless. Everybody has that brother or uncle or neighbor that says, oh, well, this is going to happen or that's going to happen. And the vast majority of the time they're wrong, and the times that they're right, they're usually just simply lucky. A broken clock is right twice a day, right? The old saying. But when you kind of look at what happened in the fourth quarter, I mean, the fourth quarter was a over-dramatic result of worry about what is going to happen in 2019 and what's coming down the line for corporate earnings. And as the data ultimately showed in the first quarter, that that worry was overblown. And so those that were predicting a deep recession and saying sell all your stocks, ultimately proved to be terrible advice. As the stock market rebounded, I've been saying to people, if you closed your eyes for the last 6 months, you wouldn't even notice anything happened. But the fourth quarter of 2018 was a pretty dramatic decline, and the first quarter of 2019 was a pretty dramatic increase. There's the old saying that the stock market has predicted 9 of the last 5 recessions, and that's fairly accurate. The stock market tends to overreact to news, but in the long run kind of comes to equilibrium based on the facts. So we're certainly glad to see things rebound in the first quarter. We're glad to see clients stick with their investment plans. The portfolios are built to deal with volatile bumps like the fourth quarter. So that fortunately worked out pretty well. On top of that, for clients that have non-retirement accounts with us, if there were tax losses, we took a ton of tax losses in the fourth quarter that ultimately allows people to deduct those losses against any gains they have. And if they don't have any gains, then deduct it against some of their ordinary income, which the end result is saving a lot of money on taxes. On top of that, any rebalancing that we did using excess cash from year-end distributions or deposits was able to take advantage of the decline that happened over the fourth quarter and early on in the first quarter as the markets marched their way up. So bumpy periods, while as uncomfortable as they are to go through, certainly can provide some silver linings for those with cash to invest, excess cash to invest, or for those that have tax losses that can be very valuable to take and offset other income and save yourself money on your tax return. So speaking of taxes, don't forget 2018, of course, was the first year of reporting under the new massive tax law change that happened. There were a fair amount of surprises for a lot of people, but keep in mind that your advisor here at Level would very much like to see your 2018 tax return. So we can be certain that we're doing everything we can with your portfolio and the financial advice that we give you to help you minimize your tax bill. And the 2018 tax return is really the first iteration of what do things look like now under the new code, and what things can we do. And there certainly are a fair amount of things that can be done. So if you've done your taxes, which you should have by now, please send in your tax return to us. We're happy to take a look at it and see if we might be able to find any strategies to reduce your tax bill. One last thing I'd like to show in a couple of different charts here from JP Morgan is how the yield curve has flattened. Now, as a introductory course to the yield curve, what is that? That is simply the current interest rate or yield that different term or maturity treasury bonds and bills are paying. So what are short-term bonds paying, what are intermediate term bonds paying, and what are long-term bonds paying? And generally, the curve goes upward. And we all know that and see that throughout the market when we're trying to buy things like CDs. Usually short-term CDs pay quite a bit less than long-term CDs. And usually short-term treasury bills pay quite a bit less than long-term government bonds. But in today's environment, because the Federal Reserve's been raising rates for a couple of years, and because the long-term view of the economy is still moderately positive, but not wildly positive, there's only a slight positive upward trend in the yield curve, and a certain part of the area, a slight dip. So we point this out really for a couple of reasons. In constructing your portfolios, we generally tend to favor short to intermediate term bonds because the volatility of longer term bonds we often think is not quite worth putting up with, knowing that that's our safe asset, the safe side of our portfolio. But especially in an environment like today, you're not really getting much extra return for buying longer term bonds. So we want to point that out, but we want to point out a second area that this affects you, and we have been talking to a ton of our clients about this and want to make sure that everyone is well aware. The rates that are being paid on savings accounts inside of banks and what can be earned through CDs and higher yielding savings accounts, often through online banks, big online banks that are just as safe as your local banks, is pretty dramatic. There's a pretty big difference between what people are actually getting paid and what they should actually be getting based on what the federal funds rate is that's set by the Federal Reserve. So we're seeing online savings accounts in the range of 2.2 to 2.45% for FDIC insured savings accounts. But hear from a lot of our clients that their local banks are paying either nothing or next to nothing, or 0.25% or 0.5%. And that is a very large difference. And we've got a chart here from JP Morgan that kind of shows how big that difference is, and not only how big that difference is, but where the inflation rate is. So keep in mind, if your savings account is earning 0.25% and inflation is 2.25%, you are effectively losing 2% a year purchasing power on that money. In real terms, that money is becoming less valuable. So we're really trying to make sure everyone understands that. Talk to your advisor here about what we can do about that. What savings accounts out there are paying decent yields, whether that's locally or whether that's online. What other options do people have to actually try and earn some real interest on their savings? This is not really an investment question. It's outside the realm of portfolio management, but it's some of the most valuable advice we've been giving people is, how can we actually earn some interest on our savings accounts? So don't hesitate to call or email us or schedule a meeting with your advisor to talk about, your 2018 tax return, to get an update on the portfolio and how it's going, and to talk about those savings accounts so we can actually get everybody earning some real interest. So I just want to thank everybody for tuning in. Like I said, if you have questions, don't hesitate to call or email us, and we look forward to talking to you next quarter.